All right, this is the second series in my matrix levels as to how to identify major market turns and how to effectively use the numbers that are in front of you. Most people just look at the numbers and their eyes glaze over and they fail to see just exactly how powerful these levels are. You know, matrix numbers are levels that never go away. You know, whether it's this year, 10 years from now, 20 years from now, markets have memory and markets will come back and honor these levels. So let us just start out with the S&P break. Oh, here, let's go to this other screen first. So you can see the spreads and everything else. And we'll start out with how this break started. Okay, let's get the S&Ps up here. Okay, and the first thing you do is when you're looking up, you don't want to look at a daily chart. You always want to look at at least a daily continuation, or you're going to look at the wrong data. And we're going to put up a couple other charts just so you can see what's going on. We're going to put up S&P bonds. And we're going to put up NASDAQ bonds. So we're just going to leave these two charts up here. All right. Well, okay. So there are two charts in each of these. There's the all sessions, which goes back to 1997, which is the electronic sessions, okay? But the pit session and the S&Ps and the bonds started trading in 1977 and the S&P started trading in 1982. So if you go to a pit chart, you'll get more historical data. But for right now, that's not what we're looking at, okay? All right, so the S&Ps, the one thing we knew in the NASDAQ bonds was that 50 even and I've showed you these charts before on a weekly, quarterly, yearly. 50 even is the pivot. It's run innumerable 700-point swings in the NASDAQ. And below it, you just had another 700-point break. You know, the NASDAQ bonds broke down, you know, May 6th, had a pretty good break. We came all the way back up. Now you had another ORL week that started on that Trump tweet Thursday afternoon about China. Once it broke that low, the low of that bar, which is 50.56 and stayed below it, it was over. All right. So now how do you know where it's going to go? You take a look at your sheets. You know, you have a quarterly pivot in the S&Ps on your sheets. You have a zone. You know, once it starts closing below 51.5, it's over. In the S&Ps themselves. So what was that close at Thursday? It closed at 48.75. Okay. So that's not a good sign. And then on Friday, it tried one more time to rally a little bit, and then it just started selling off. Now, how do you match up below? Well, if you look at the new sheets, the one number I didn't have down there was 2784. I had 2811 because I didn't think it was going to be that big of a break before I left. But in the meantime, you had the levels. The first time down into here, you know, anytime you get near a 200-day in the S&Ps, the NASDAQ 100, whatever it is, it's bounce time. So how do you line that up? Well, the RSI was below 18% in the S&Ps, and I don't think it was much better in the NASDAQ. Let's take a look. The NASDAQ went right down to its 200-day moving average and stopped right there at 72.25. And, that was just below a matrix level. Now, remember, the big thing about matrix levels is they're closing levels. So you look at the level and you look at the major moving averages around them. And this time, in both instances, you had a 200-day there. So this is an area, no matter what, if it's coming into it the first time, you should be out of your shorts. You should not be hanging around being short into a 200-day moving average. Okay, and I know Matt had all you guys short, okay? That's a mandatory cover zone. It's absolutely lunacy not to take your money at a level like that and see what happens. It's a free out, okay? Especially with the RSIs totally relieved and now in a major oversold condition, okay? So you had an out in both of them. Now, what else did you have that tells you that that was going to be the low? That same day, the next day, you had the high in the bonds. Now, most of you guys knew that before I left, some of the guys were getting out of their long bonds that they've been in for a year, and I thought it was going. I thought there was another 6 points in the trade. Actually, there was another 8 points in the trade. 1, 2, 3, 4, 5 days, 8 points. So when you see the match on your sheet in the bonds, it's the bond highs, the bond levels, the extremes in the S&Ps, the NASDAQ, they're all going to come in. They're all going to be hitting or at matrix levels at the same time. You also have a major matrix level getting hit in the gold, right? So the more of these markets that line up at the same time, the bigger the turn's going to be. So you had the NASDAQ, the S&Ps, the 30-year bonds, and the gold, which has been a big component of this whole trade, all hitting major numbers at the same time. When you see that, the more of these things that line up, and you're going to see this 3 or 4 times a year, sometimes 5, it's going to be a big turning moment. So, if you're short and you've been risk off, it's time to take your money and look for a really big bounce the other way. Now, you don't know, for example, if that's going to be the stone cold low in the S&Ps or if that's going to be the stone cold low in the NASDAQ. I mean, could we come down there and retest it again? Yeah. And why do I say that? Is because I don't like how the shorter term equity bond spreads trade. They've been lagging the rally in the indices. So one's not right and I don't know which one yet. So I'm paying attention to it, okay? Now the other thing that you had to match up with the low, wrong chart. You always match up the big cap stocks. Okay? Because the big cap stocks are going to line up with the low and all this stuff, okay? You had a gap fill, an earnings gap fill in Google on the low day. I mean, if, you know, I look at all these different moving parts, most people don't. You know, they don't put that into their matching mentality. The more things that line up, the bigger the turn's going to be. When you get a gap fill like that in Google, I mean, look what it's done. So now, you know, that alone, that gap fill down there's telling you, you know, you can get another really big bounce if it starts up. So you don't want to be short. You know, you're looking to trade it the other way for a rebound. Now, how high the rebound goes, you know, it's stalling out right now below our quarterly pivot, right? Can't trade the quarterly pivot. You know, it missed trading it again on Friday in the S&Ps. Now, can it, you know, and what do we do on Friday? We went up to the 50-day moving average and just stopped again. Now, you know, I'm not making a call here. It's the market direction. I'll let the market at this point tell me what it's going to do, okay? Now, Ezra's, you know, that's a secondary thing, Ezra, whether the peso's done something. Here. You know, you got a double top in dollar Mexican, which is basically a double bottom in the Mexican peso futures. And you had to move right back to the 200-day. Okay, now what? Now it's, you know, you're at resistance in the peso and the indices are at resistance. So are we going to grind through here and start another leg up, or do we reject again? You know, that's the game you're playing, and that's why on Friday I said no positions. It just wasn't worth it, because now it's going to be a trader's market to see how some of this pans out over the next week or two. Market's going to remain thin, and with 40, 50-point daily S&P swings, there's absolutely no reason to be involved. You know, the other thing I was looking at, you know, you almost got the complete here were the S&Ps, okay? They started breaking late Thursday. They came all the way down here to basically fill out the bottom of value down in here, which also lines up with our matrix level. Now they've reversed back up. Now you've had a 100-point back up, right? So, you know, this 35 to 45, you know, this whole, anything from 44 to 55 is going to be brutal now. Okay, so this is the area that the bulls have to get it through for any type of a rally and to run out the shorts, because guys are all selling against this level now. You know, it's a multi-year level. Everybody knows it. And, you know, but we've had it on the sheets before anybody even started picking it up, you know, off their general charts. And that's what's the beauty about the matrix level, is you don't have to sit there and do short-term, you know, fib work. You don't, all you have to do is look at the sheet, you know, pretty much where it wants to go. Then you match that up with the bigger moving averages. And, you know, it gets back down to the speed of the move. You know, this was a pretty fast move. So when you get a fast move like that over 3-4 days, and it goes to a massively oversold condition, you know, below 18%, the last thing you want to do is be short into a 200-day moving average. That's telling you you're looking for a big rebound going the other way. I mean, Pax sent me a note. It was like the middle of the night. And, you know, I just told him to start looking for a 100-point rally. If nothing else, just a 100-point relief rally to run out all the shorts again. And that's what you got. And now it's consolidating, trying to make another move. And that's why we're being patient and letting the market tell us what we want to do here. So I'll open up the floor to you guys for questions. So, that's my process. I'm looking at how many of these matrix levels hit at the same time, and are they major levels? And remember, they're all closing levels. So yeah, they can overrun them a little bit. Sometimes they stop right at them. Sometimes they go to them to the tick. And sometimes they'll line up like this with a 200-day moving average in the S&Ps, or right down to the 200-day in the in the NASDAQ. You can't get a better low than that. To not only, it's a free out if you're short, but it's an area where you buy them before you sell them. You don't sit there and sell the first 5 ticks up. It's a major freaking thing. And that's why I look at Google, Amazon, Apple. I'll go back and I'll start looking at all the big cap stocks, because you know what? They're all lining up with it. Apple came down to the top of the cloud. Then it screwed around. Then the next day, Apple put in an ORH day and took off again. Okay? So you can make money trading the individual names off these levels. All this stuff is going to line up at the same time. I mean, look at Amazon. Amazon went right down to the 200-day. So you had the 200-day in Amazon, 200-day in the NASDAQ, 200-day in the S&Ps. You got the gap fill in Google. You got the high in the 30-year bonds. You got the high in the gold. I mean, how many more things you want to line up at once? It's the freaking slot machine in Vegas. 7s are coming up all the way through on the pull of the handle. And you're going to see these turns 4 or 5 times a year, and they're big turns. You only have to catch one. So, on Friday, late in the day, that's why I took off some of my minors, because it's just going to be a squirrely end of the week with options expirations and monthlies. And I don't want to get caught up in the month-end gains. So that's kind of my view on how you put the board together. And everything will line up on a major turn like that. The indices will, the bonds will, the gold will, not so much the currencies this time, but you also got a telegraph in the Mexican peso, which is, if that's going to bottom, then you're going to get and you got a risk on bounce. So here's the peso futures. It put in a lower low, and then it rallied back up to its 200-day. So now you're at levels and everything where you got to see what it wants to do. Okay, I'll open up the floor to you guys for questions. Unmute yourself and ask the question so everybody can hear you.
Okay, so it's Ezra again. Thanks for the explanation, Judd.
Okay.
So what I'm deriving from this is really for me to be doing my homework at the end of every close each day. I should just be checking big cap stocks, gold, 30-year T-bonds, and that should help give me a picture. When those things line up at an extreme, whether it's a top or a bottom, it'll give me a picture of where the next move will be, and the matrix is giving me the roadmap to that next number.
Yeah, and it'll bounce from one to the next. It's going to go to the next closest number.
Okay.
That's what they do.
All right. Previously, you mentioned lagging risk spreads. How do risk spreads factor in to this analysis?
Well, I'm just looking at the risk spreads for confirmation. Okay.
So those are more of a secondary thing to confirm what you're already seeing.
Right. I want to know if the move's real. Okay. So what I'm trying to discern from the risk spreads, you had the ORL weeks in, put in on a Friday in the risk spreads. So for sure, you don't want to be going home long anything. If anything, you're short and you're looking to press on Sunday night. And you got rewarded in Monday and Tuesday. And here on the short term, on the first, the S&P bonds close back below their 200-day moving average, right away that's telling you the market's weak. And it wasn't oversold yet. I mean, the spread got down to about 23% on the 6th, but you had a couple of days of follow through. And you can see where you get these ORL weak like that, and the NASDAQ bonds, this thing's coming undone. Now you got a big gap in the spread, which matches the quarterly pivots in the straight indices now.
So regarding those S&P bonds and NASDAQ bonds, there's obviously a lot of different S&P bonds. Some are sector based and whatnot.
Just use the futures. You're using S&P 500 futures against 30-year bond futures, period.
So I did find one. There was an S&P 500 a future bond, but it went back 2 years. So I'm trying to find the one that goes back to was it 82? No, 77.
What front end are you trying to get that off of?
I use Thinkorswim and I have TradingView.
Okay, so neither of them are going to have historical data.
Okay.
So that's why you can't get it. My stuff goes back to life of contract. Most of these guys, their idea of historical data is a 1-second chart.
Yeah.
It's useless. It's useless.
For purposes of what we're talking about, well, yeah. What you mean.
So you'll have to just look at it on my screens in the morning.
Gotcha.
Because you're not going to get them anywhere else, and you can't. And even on Bloomberg, you're going to be able to pull a line chart. But here, I'll give you a line chart on this. Hold on. All right. Can you do any technical work on that? You see that black line?
Yeah.
If you use Bloomberg, that's what you're going to see. It's utterly useless. Bloomberg is utterly useless for charting. So, that's what you're looking for there. I mean, that's a problem. And most of these charting services, that's what you're going to get. It won't give you a spread bar, and they won't calculate the spread bars properly. So you're not going to be able to see the stuff. Even if, when I go Bund DAX and a lot of the spreads that you see me put up, all of it's calculated wrong on every other platform, including Bloomberg.
Okay.
All right, anybody else, guys?
If no one else has any questions, I have another one. I don't want to monopolize.
Keep asking, because that's why we're here, to answer questions and give everybody a little bit more vision on what's going on.
Okay, let's take this last move. We'll use this as an example. So, right before, like the day after, I think the day that you were leaving for vacation, the price broke July 31st or so. Start moving down. We had Trump and team tweeting and stuff and manipulating and stuff, moved around a bit, but then it continued further down. We got through our matrix level. It bounced off the 200 DMA and came back up. Now, when it came back up, you often say about the 50% level between matrix levels, and it did go there, and there was contention for price, right?
Right.
And then it continued to move up. Let's say I missed the move down. It bounces, and it's hovering around that 50% level. When it's in that level, do I just sit on my hands and wait to see what happens? Because it's pretty clear to me right now, the bounce, that makes sense to me. Now, it makes almost perfect sense now looking at it the way you're looking at it. But when it got to that 50% level, let's say around 28.80, it seems like if I don't know whether it's going to continue up or go back down again, it would be a dangerous place to trade.
Well, it is. And it's a better exit to peel off some of your shorts than it is to initiate a trade.
I got you.
Because
So
all you're doing is using that 50% level to manage risk the first time in. Doesn't mean it's going to honor it. It just means, you've seen it in the gold, how these levels, 1440 was one of those in between levels, 1460 to 65. I mean, every time it went to one of those levels, you got price rejection. And then once it started going through it, it just went to the next level. So all it is an area where you don't press direction. So the first time into that 50%, the last thing you want to do if it's going down is to sell into it. You have to let the market show you what it wants to do there. Okay.
Okay. So to that point, let's say we're at that 50% level, around 2880 or so.
Okay.
And let's say I missed the bounce and I want to get in. Should I just not get in and just wait for it to get to the next matrix level?
No, well, I mean, once you see it, not holding 2880 and it starts going, and PAX is starting to sell weakness again, I'd get on it with them, Okay. Gotcha. I wasn't in front of the screen. So, I had no idea. All I knew is that once I stepped into O'Hare, it was going to get busy. And then PAX said, the bottom just dropped out of the market, and I had just gotten in the line to check in.
Gotcha.
I just started laughing. So I sent him a text when I was going back to the airport in Madrid. Hey, I'm at the airport. That's when the bottom was put in.
Okay.
So, I'm a little superstitious that way. I've just seen it work too many times. 80, 84, 85 with the pound. Some things just happen like that. So, yeah, that's how you use those 50% levels.
And for where we're at right now, since we're, I know we closed a little under the matrix level, which, was a big level. I guess we have to look to these other things to see what the next move will be. And they have to find some either support or resistance or whatnot to determine the next direction. So right now, I guess we wouldn't know the direction until what happens Monday.
Yeah, we're going to just wait and see what happens. I mean, I just don't think that the ranges are big enough right now that you don't have to have a position. The only thing, I lighten up in my gold and look, I bought the gold down in here, somewhere in here, okay, in the minors. I got out the first time at that I got out at 1438. It actually went a little higher because this is the pit session. The all session was actually got up higher. Then it came down and congested for a while. So I was out of the gold for almost a month. And then on the Fed day, it was a Wednesday. That's when I got back in again. Can't remember what day it was, but around 1453, I started buying it all back again. I think this was the day it came down, filled the gap, and started up late day, and then I bought it. And caught another $100 in this thing.
Yeah, it was a nice move.
Yeah. So, you don't have to be in all the time. And I used calls this time because I wasn't going to be in front of a screen and I wasn't going to be able to trade. And, I wanted to participate. I thought that was the best trade on the board.
Okay.
So you can skin it any way you want. You can use options. You can use futures. It doesn't matter how you do it. It's whatever style of trading suits you is the right one for you.
Gotcha. Can we shift to 30-year bond futures?
Sure.
Okay. So, obviously risk on in equities would be risk off in bonds and.
Well, not necessarily. Okay.
But that leads to my question. So sometimes, bonds and equities move inverse to each other. And sometimes for brief periods, they move in parity.
Well, if I go and put up, hold on, let me put up a pit chart. Okay. Okay, here's the pit bonds. And the reason I look at both charts, okay, is because the pit bonds go back to 1977. If you look at the all session, the Globex stuff, that's only 1997, okay?
Gotcha.
Hold on. What the hell? Now, let me show you. Now, let me put the other chart up. Let me give you the S&Ps, the pit S&Ps. The pit S&Ps has been in a bull market since 1982, since, October, the first week in October 1982, the S&Ps broke out above 116. Think about it. We're trading at, we just went to 30,000 in the S&Ps. They broke out in 1982, the first week in October, at 116 and a quarter or 116 and a half was the opening range of the S&Ps futures. Yeah, 116.70 was the opening. In 1982, the 30-year bonds started a rally. The S&Ps went up, the bonds went up. The lower rates, this is all lower rates, and we're still going up in the equities, okay?
Right.
All right, so the beauty of the spreads is that it shows you the divergence in the risk appetite, okay? And it allows you to get some really big trades when you see these divergences like this, where you got an outsider versus a lower week at the beginning of May, you had a really big break in the NASDAQ. Now you have an outsider versus a lower week, you had a 700-point break in the NASDAQ. So it helps you telegraph the short-term moves. And that's why I use it. Because when I see confirmation through the matrix levels and I see confirmation in the risk spreads, then I know we're going to go. A lot of times on this up over the like last year, and you're in a situation where the charts are broken because of QE. And you've heard Ira and I talk about this before. The charts are broken because of QE. And you might have a day where, it looks like it's a topping pattern, like this one was a good one in the 1st of October last year, and Matt caught that whole break. All the way down into December. And he caught it here again. The December break was even a better one to catch. Right back down to the 200-week moving average, and boom. Always look at these big 200s, whether it's a daily, weekly, monthly, whatever. It's big time stuff. You match those up with your matrix levels, and you got a big trade.
So it sounds like the 200, when you're looking at a daily, weekly, monthlies, it's a safe entry because it's going to move off of that extreme.
Well, and it's an exit. If you're short, it's an exit. That was a Wednesday. This is a Wednesday low, okay? And I wrote that Wednesday for all the RIAs or anybody else who cared to listen. If you need to have long exposure going into the beginning of the year, buy it now. Don't wait for the rally and get in where everybody else gets in. You want to have a lead on it. So that's trading capital flows along with using your averages and using your matrix levels to give you a leg up on everybody else in the world that's going, oh, the world's coming to an end, and they're not doing their homework.
Okay. Should volume be a consideration in the analysis?
Totally irrelevant for me.
Okay.
I mean, some people are big volume guys. I am not. Langer isn't. all we care about is price.
Gotcha. And moving from one price level to the next. That's it.
Yeah, and the point and figures, this is, you've heard PAX talk about it before, how market profile doesn't work anymore. And even the guy that designed it said it didn't work anymore. Yet all these people are still using it.
Right, right.
Okay, well, you know what works? Point and figures.
I have to say, since using your service, the point and figure has been spot on consistently.
Yeah, Dorsey Wright, who his stuff, I think, for me, I find it utterly useless, okay? But all these RIAs, they all use them. I think he sold his it's all point and figures. I think he sold it once for like 25 million. But, it shows you, even coming down into here, not only do we have matrix levels, not only did it, it wind up, here, that's the pit, but let's look at the all session. Hit the 200-day moving average. That low is also a matrix level, right? And started coming back up. And, right here, that's the bottom of value on the point and figure. They all come in at the same time. So this is just one more confirming thing to tell you, look, the downside's played out. Even if it did break, you're not going to miss much. Okay, it's an area to exit. And the 200-day moving average and the matrix told you it was a place to look for a bounce going back the other way.
One thing and maybe you'll disagree, but with the PNF charts, one thing I realize, it helps you to realize precisely where you're wrong, so.
Yeah, and it gets into these zones, and you need to see, all new price action to go anywhere. Even on this one, on the 50, once it broke this low, which was, or what was it? Well, I think we went down to like 29.65 at night, and then we were trading at what, 30.14 or something before Trump announced that stuff when I was in the airport. I know that Matt told me he was, he had 30, 40 handles and some runners.
Yeah, he killed it. I was in the room with his room that day, and he killed it for sure.
Yeah. And that's all he's doing. He's doing the exact same thing. And he just does it time and time and time again. And that's what you should be doing. It's a repeatable deal. It never changes. So it tells you, like, even here where you could kind of see a little double top the first time up into the 29.50 level, and then we had another break. And that was a 100-point break, 100 and some point break.
Let's look at that July 31st break, the one that Matt really killed it. It went down, like you said, to the 29.65 level, and then it bounced right back up. And I think the bounce was more event driven. But if I'm taking the short based off of lining up, the bond futures and gold and so forth, I imagine I would have gotten stopped out,
Well, right, but Ezra, anytime you get a spike like that, okay, and you take out the low, here, the low was, I don't know what the low of that day was. It went down to 29.58 and didn't fill the, here, let me put up the pit chart, because it missed filling the pit gap again. Here, let's just go back and look at that.
No, I saw that. You're right. It went to 29.58. I think the gap was 29.55 from my recollection.
Right. Where was it? Oh, was it this gap? Yeah, right there. Yeah, right here. So it came just shy of it, came all the way back up. Once it took out that low and closed below the gap, that's really bearish, okay?
Gotcha. Okay.
Once you close below one of these gaps, that becomes really bearish. Or if it's, if you're starting up and you start closing back up above one of these gaps, then it becomes a bullish indicator. All right, so here, here's another day where, you had a pit ORL day on July 19th. And if I go back, and let me just look at and this was a day I think I wrote about, I don't believe the signal. I got to be shown that the signal's right, because the S&P bonds never put the ORL in, but the pit did, okay?
I remember you saying you didn't believe it. I remember that day clearly.
Okay, so one of the reasons is then I go back into my spread charts and I look to see if I think the move's real or not. And, you're down into these averages and it's just like, I'm not buying it. And and I don't know which day of the week that was, but I'm sure it was the wrong day of the week for me for some reason. Let me just look at what. Yeah, July 19th was a Friday. Didn't believe it. So, that's all part of the process of thinking about the trades.
Right. So, midweek shuffles Wednesday, and I'm going to shift gears a little bit. So midweek shuffles you speak about, and I remember a few weeks ago we were talking about like the Tuesday close, Wednesday open, and there was I believe there was some correlation that you and Angelo were speaking about relating to weekly bars and that midweek shuffle. And I didn't catch everything you were saying. And Angelo was like, once he understood that what was going on there, it really enhanced his view.
Well, because you're looking for midweek shuffle when you go back and read the definition, okay? Yep. And this is Howard Green 101. This guy was a freaking maniac. And he was the guy that taught Ironeye.
I remember you saying, yeah.
Okay, so for him, all he would ever say to us was, "It's Wednesday, you dumb shits. It's Wednesday." That's all he would say to us. He said, "What's the matter with you guys? It's Wednesday." Wednesday, the midweek stuff, whether it's a Tuesday or a Wednesday or a Thursday, you're looking for, markets don't go straight up or straight down. They spend the middle part of the week trying to get everybody out of their positions, with contra trend price action. So if you're looking for a trend change and the market's been up for weeks, you're looking for it to happen midweek. Now you just got it 2 weeks ago again on a midweek high. Now you've come up on a Wednesday, we kind of rejected this week. Thursday, we kind of rejected, and we're still sitting around here. Excuse me. So next week's midweek shuffle, whether it's a high or low, is going to tell us if the market's going to try up or it's going to go down for the next couple of weeks. And hold on a second. Technical models are lagging indicators, okay? They're trend indicators. So the midweek shuffle tells you whether a market's trying to turn from up to down or down to up. And it says a lot about the condition of the market and how it's trading and what people are trying to do. So it's just one more thing that I put into my mental process to see if I want to do something. Now, an example was that I'll give you an example in the bonds. I think July 31st was a Wednesday, okay? And it was month end. And this is where Angelo took off a 20-point winner in his bonds. And I'm looking at the market thinking, well, the first of the month's tomorrow, and I would rather, if I had a position on that long just for money management, would have been to use a 153 closing stop because that's where the 200-week moving average came in. Okay.
And I remember you telling him that. I remember you speaking about that in the room, actually. So
Yeah. So
I agree precisely. Yeah.
I'm not gonna, it's not my place to argue with a guy that's just made 20 figures in the bonds. He knew why he was taking them off. It was the right day of the week for him, and he was taking his money, plain and simple. He'd been in the trade for a year, and there was nothing to complain about. For me, I would have rather seen it take that 200 week out and then sell them, on a risk reward basis. Because I told you guys, I thought the bonds were going to go over 163. And that's exactly what they did when I was gone. But, he made a fortune on that trade, a fortune. So, and he took them off on a midweek high. And that's exactly what you're supposed to do. All right, anybody else have any other questions? I know you're all sitting there silent, but unmute yourselves and ask them. Jack?
So I have one more thing that's more of an intraday question.
Okay.
You're curating the board day to day, and what is your process for determining the market direction? Because I've seen you call it very well often, and sometimes you say, well, I can't tell, so right here I don't know. And then there's other times you're like, hey guys, it's taking off right now. Is it just monitoring big cap stocks that are driving the indices, or are there?
Well, it's everything. I mean, that's 45 years of empirical observation, looking up and knowing what's wagging the dog.
Right. Okay.
And I got to see, sometimes it might be the chips, sometimes it's Google and Amazon, sometimes it might be healthcare. Generally, it's not so much energy anymore. And, it rotates. So you just have to be aware of it and try to pick up on the stock rotation. You have stock rotation, you have time frame trading, you have capital flow trading. And then, the indices, like a lot of these days, you hear me, Matt will get chopped up. And, and I'll have that conversation in the morning. You don't want to overtrade here for a bit because, like last Thursday, when Google and Amazon were trying to figure out what they wanted to do. And first they got the gap to the upside, then they got the gap to the downside, and then they took off. And that was all matching up with the pit gap in the S&Ps at what it was this day at 2902. Just after the opening, the opening was 28.99. 02 was half of the pit gap, and it was just torturing everybody in there. And all that is when you get a 50% level like that, until you see it really hold above it, then you go with it. You don't have to be the first one in because, you'll get your face ripped off, over trading it, waiting for it to set up to go. Because the S&Ps don't run the show. It's a lagging indice. Most of the indices lag. They don't lead, they lag. So I'm looking at the names and the sectors that are leading.
And if they're mixed, then you would say, okay, this is going to indicate some chop and indecision in the price action.
Yeah, well, I can see it before it even gets going. And that's why PAX has got a 2 times in your out rule. You just don't sit there clicking the mouse and clicking the mouse and clicking the mouse.
It's a good way to make the broker money, but not yourself. Yeah.
Right. And all it does is make you unhappy. And then you miss a move. Then you're really unhappy. All right. Anybody else, guys?
Good.
Yeah.
Purely technical.
Okay.
You mentioned, and I see you marking out breakdown levels, and it's generally the low of the last day or the last week of price before a major breakdown. I was just wondering, what is the significance of those levels to you? Are they closing levels? How, where, why, all that stuff? Those
Okay.
breakdown levels.
So, Jack, that's why I always monitor all these levels, right? These ORL levels or new low levels like this one at 2978.80. Okay. Well, that's a weekly, but here, let's get it on a daily. Here, what day was this? That was July 31st, right? That's when we opened lower, took off. Wait a second. Oh, that was the second day. But, here's what's that low? That low was 30.02. Once it went below 30.02, they rinsed it all the way down into the matrix levels, right into the quarterly pivot. Okay. So anytime you get an ORH or an ORL level, you want to pay attention to it because you're looking for confirmation. Is this just a stop run and they're going to come right back up? So it's a really good place to key off of to see if is it a false breakdown or is it a real breakdown? And that's when you really want to start paying attention because, the algorithms try to go to these areas and elect stops. And if they don't elect them and they start back up, that tells you can buy against that level. If they come underneath a level like that and stay underneath it, you don't want to buy anything. You're looking to sell any failed rally.
Got it. And on the way back up, let's say that we get some confirmation of price action on the way back up. That's the level we'd be looking at, possibly a target area.
Yeah. So here's I don't know what day was what day of the week was the 7th. That's a Wednesday. Okay. You got a Wednesday low at a matrix level overnight. They put an ORH day in. They get the stops above 28.83, right? They didn't quite close above the ORH number, but you still have, if you look at this thing, the candle, it's an engulfing bullish candle, right? Last thing you want to do on a pattern like that is be short, okay? Whatever you're doing, you're not short. Either you're long and going with it, but you're not short. So, it's about as much as what you do is what you don't do. And right here, that's telling you don't be short no matter what. And then the trade went right back up into the 50-day moving average again and just shy of the matrix levels. So that's why you always look at these bars. They tell you something about the market. Here. Let's look at the oil. July 12th. The sell stops were 59.93. I'm sure if you go back to like a 240-minute chart or something else, let me guess, July 12th was a Wednesday. It was a Friday. But once it stays below that level, it's no good, okay? Then the next day, it came all the way back up and showed you the level again and then broke. So it's going to become a big inflection point. That's why you look at them. It tells you what the market's going to do. And a lot of times they'll come back and retest them just to check the level. And if they fail there, the last thing you want to do is buy them. You sell them before you buy them. Just keep that mentally in your head.
Because I have been watching these levels, and something which always sticks in my mind is does a retest of that level. So let's say we've got that level that was at the 12th, you say.
Right.
So on the 14th, we got a retest of that level.
Yeah, on the 16th, it went back up there. And what the high was 60.06 overnight, and it totally rejected it.
So for example, we come on in the morning, we see there's a rejection of that level. Does that provide us with some bias for direction for that day?
Yeah, and going forward, you know, you don't have to be long until it closes back over 59.93.
Yeah, I've got it.
Let me jump on that. That was a great question. So it retested the level, but if you when it broke the stops and you took the short the day before and then it went back up and retested, what would be the reentry? Would you be looking at a PNF chart to gauge your reentry?
Well, yeah, and you also had a matrix level up there too, a whole matrix zone. And I don't think it.
I'm looking at, yeah, you're right. Okay, now that I'm looking at that, I gotcha.
Okay, so you also had confirmation of a matrix breakdown. So not only do you have a chart pattern level that you want to watch, but you got a level up there, a matching zone, which is a closing level on the matrix sheets. And once it closes below it, it's going to the next one lower. And that next one lower was 300 points.
Yep.
So that's how you put that together.
Thank you, Judd.
You're welcome. All right. Anybody else have any questions, guys? Otherwise, I'm going to wrap this up. So now's a good time for you guys to ask any of these questions you want. Okay, gentlemen. I hope that clarifies a lot of stuff. And just remember, you're going to get these, the whole idea about using the matrix work is matching it up with the big cap stocks, the bonds, the golds, all this stuff. It's not coincidence that it all lines up. All these turns are going to line up.
Judd, thank you for your time. Definitely appreciate it.
You're welcome. Okay, everybody. Thanks for attending, and I hope that helped. Okay, guys. Thank you.